In this video, we will explore about support and resistance as well as trend lines and channels. These are the foundational concepts of technical analysis that will help you identify the best times to enter or exit a trade. Let us start by understanding the core concepts of support and resistance. Imagine a ball bouncing inside a room. The floor is the support. This is a price level where a downtrend tends to pause because there is a concentration of demand or buying interest. It stops the price from falling further. On the other hand, the ceiling is the resistance. This is a level where an uptrend pauses because of a concentration of supply or selling pressure. It acts as a barrier that the price struggles to break. Your goal is to identify these turning points to manage your risk effectively. So, why do these invisible lines matter so much? There are 4 key reasons. First, they act as psychological anchors. Traders like you and me remember past price levels where the market reversed and we expect it to happen again. Second, they create order clustering. Many investors place their buy and sell orders near these specific levels. Third, they are crucial for risk management because they help you decide exactly where to place your stop loss or take profit orders. Finally, they help with trend confirmation. If a price breaks through a level or bounces off it, it confirms where the market is heading. Now, let us look at the different types of support and resistance. The most common is horizontal, which are flat levels where the price repeatedly reverses. For example, a stock might struggle to go above 1950 rupees. Then we have trend lines, which are diagonal lines connecting higher lows in a bull market. We also use moving averages such as the 50-day moving average, which acts as a dynamic support that moves with the price. Traders also use Fibonacci levels like the retracement of 23.6% or 38.2%. Pivot points are calculated using math from the previous day's data. And finally, we have psychological levels, which are round numbers like 25,000 for the Nifty, acting as natural barriers. An interesting phenomenon you must know is role reversal. This is when a floor becomes a ceiling or vice versa. Once a support level is broken, it often flips to become a new resistance level. Why does this happen? It is driven by 3 factors. First are trap traders who are trying to exit at a break-even point. Second is a shift in market sentiment where psychology flips. And third involves institutional orders where big players reposition their large trades. One of the most exciting moments in trading is a breakout, but you must be careful of false breakouts. A true breakout happens when the price moves decisively beyond a level, and crucially, it is confirmed by high volume. This is marked by the green check on your screen. In contrast, a false breakout is a trap. The price temporarily crosses the line but quickly reverses back, often on low volume. To validate a real move, always look for volume spikes and candlestick patterns like a bullish engulfing candle. To find these levels accurately, we use a combination of tools. You can look at price action by identifying swing highs and lows or consolidation zones where the price moves sideways. You can use indicators like MACD, Bollinger Bands or RSI levels. You can look for chart patterns like double tops or head and shoulders. And most importantly, always use volume and time analysis. High volume confirms that the level is significant. How do we measure the strength of a support or resistance level? We look at 4 factors. First is the number of touches. The more times a price hits a level and bounces, the stronger that level is. Second is volume. Higher trading volume at a level indicates greater conviction from buyers or sellers. Third is time spent. If prices consolidate near a level for a long time, it becomes more significant. And fourth is recency. Levels established recently carry more weight than those from years ago. Now, let us discuss strategic applications for your trades. You can do bounce trades where you buy near support and sell near resistance. You can do breakout trades where you enter only after a confirmed breakout with high volume. You can look for pullback entries, which is waiting for the price to return and retest a broken level before entering. And importantly, use these levels for stop loss placement. Put your stop loss just below support if you are buying or just above resistance if you are selling. However, you must be aware of limitations and advanced concepts. Remember that these levels are actually zones, not exact price points. There is also subjectivity, meaning different traders might draw lines differently. Market conditions matter too. In a very strong trend, these levels might be ignored, and major news or events can easily override any technical level. For advanced traders, concepts like order blocks, liquidity pools, and the volume weighted average price or VWAP provide deeper insights into institutional activity. Let us apply this to a real world case study involving Nifty and Reliance. Looking at the chart, Nifty found strong support around the 24,350 level from May to September 2025 after testing it multiple times. On the other hand, Reliance Industries faced strong resistance around the 1,300 level. This acted as a ceiling from October 2021 to July 2023. Eventually, it broke out in January 2024, showing how long these levels can persist. Moving on from horizontal lines, let us explore trend lines and channels. A trend line connects two or more price points to project future support or resistance. If the line slopes upwards, connecting higher lows, it indicates bullish momentum. If it slopes downwards, connecting lower highs, it indicates bearish momentum. When you draw a line parallel to the trend line, you create a channel. The space between these two parallel lines encapsulates the price range, and the width of the channel tells us about the volatility. We can use specific strategies for trend lines and channels. For bounce or range trading, you enter when the price touches the trend line with confirmation. In a channel, you buy at the lower boundary and sell at the upper boundary for breakout strategies. You wait for a decisive move out of the channel with volume. You can also use the trend line to trail your stop loss, moving it up as the trend continues. To set a target, you can project the breakout move by measuring the height of the channel. To ensure success, we must use validation techniques and avoid common pitfalls. Always look for volume. Breakouts with rising volume are reliable. Look for candlestick patterns like hammers near the lines. Use indicators like RSI divergence. Also check multi-time frame alignment. If a line appears on a weekly chart, it is stronger than on a daily chart. Avoid the pitfall of forcing lines to fit your bias. Do not ignore breakouts that invalidate your lines, and never over rely on just one line without other confirmation. Finally, let us look at a case study of Reliance Industries to see trend lines in action. You can see an uptrend line connecting the lows from 1,100 rupees to 1,400 rupees in the year 2023. By drawing a parallel line from the swing highs, we see a clear channel formation. Then, in early 2024, the price broke above the channel with volume spikes. This breakout signaled a strong bullish continuation, offering a great trading opportunity.